Hey everyone, welcome back to the IT Investor Podcast. I'm Pramod Gudishetty.
And I'm Wally Taylor. Hey, Pramod, what's new with you, man? It's been a while since we've spoken last.
Yeah, I know it has been a while, right? 2 weeks ago, I think I had my birthday party. It was quite a celebration that my family gave to me. Of course, there was a little bit of work that I helped them, but it was a lot, I will say, doing all the arrangements and everything. But, it was really great having friends and family after a long time. The good thing was we had this birthday party in my backyard at night. Yeah, and my wife always loves to have these parties at night time. It was phenomenal. I will say that everybody enjoyed it a lot.
Yeah, happy birthday to you. That's awesome.
Yeah, and it was a milestone birthday, right? Something to remember and make a memory.
Very cool.
Yeah, yeah. So, Wally, what about you? What's going on?
Nothing really super exciting, man. Just living the dad life and working and I'm going to do a 100-mile ultramarathon October 4th coming up here pretty soon. And I'm really excited about that. I did add a new piece of technology to my training. I'm one of those guys that likes gadgets and stuff where you can track things. And I bought a sweat monitor, believe it or not, where this monitor on your arm tracks how much fluids your body evaporates while you're doing a strenuous activity. On top of that, the fluids, electrolytes, things like that. So then when you closely monitor that, you can keep track of how much water and how much electrolyte you need to take in while you're participating in a 100-mile event. If you can really dial in your water and your electrolytes, you can just perform better. So I'm going to go here after this recording and go test it out on my first maiden voyage. I'll let you know how that turns out. Should be interesting to see. Other than that, nothing super exciting. Kids are playing soccer and basketball, and life's good on this end. So.
Okay, Wally, given that today we have an exciting and totally new topic to discuss. Before that, let me ask you something. When you fill up at the gas station, do you ever think, man, I wish I owned the part of this pump?
Funny, I was just at the gas station this afternoon filling up, and gas is almost $4 a gallon here in Arizona. It's like the price just jumps overnight. And I'm like, yeah, who's actually getting all this money?
Oh, wow. Yeah. Is that $4 for the regular? Unless it's more expensive than Virginia. I didn't know that part. We are probably at $3.20 or 40 cents here and there, I think. Yeah, that's crazy. Yeah. But anyways, especially when you see the oil price jump up, I feel like, I should own a part of the gas or gas well or something like that. But here is the crazy part. You can actually own a piece of that action.
Really? So you're saying I could actually own a piece of an oil well that's producing that oil that winds up being that gas in that pump?
Yes, that's what today's episode is all about, oil and gas fund. And we are going to break it down, how they work, why they come with some of the best tax breaks in the IRS code, and of course, the pros and the risks.
Okay, Pramod, you have my attention. Let's get into it. Let's start with the obvious. Why are investors even looking at oil and gas right now?
It's simple because the world still runs on it. I got some analysis in 2023. It seems about 82% of global energy came from carbon fuels like oil, coal, and natural gas. Oil alone made up about 1/3 of the world. And
here in the U.S., we're not producing enough. We're short by 5 million barrels every single day. That's why smart investors like Warren Buffett, Blackstone, they're putting billions of dollars back into U.S.
Exactly. Supply is tight, demand is strong, and energy isn't going away.
Okay, well, let's talk about what people are actually buying when they invest in an oil and gas fund.
Good point, Wally. The key term is working interest. Let me break down what it actually means. This means that you can actually own a slice of well. You get a share of the revenue, but you are also responsible for your share of the costs. So that is what is called working interest.
Okay, it's interesting. So if I buy a working interest directly, does that mean I'm in charge of actually the operations, drilling rigs, all of that?
Technically, yes, you would be responsible for the operation, but that's why most funds do something smarter more than this. They buy a non-operating working interest.
A non-operating working interest. What exactly is that?
Yeah, what it means is you still get the revenue and the tax benefits, but you don't have to run the wells or operations. Professional operators, companies like Exxon, Devon, or Continental, they handle all the drilling, and the day-to-day work. You don't need to do any of those operations.
That's awesome. So basically, you get the upside of being an owner of the well without having to wear the hard hat and be out there in the field.
Exactly.
All right. Well, now here's the juicy part, the tax benefits. Everyone always says oil and gas is loaded with IRS perks. Pramod, what exactly are they talking about?
Yeah, sure, Wally. There are three big ones to discuss over here. The first one is the IDC. What it means is intangible drilling costs. These are the costs that you can't resell. Things like labor, fuel, drilling fluids, they usually make up about 80 to 90% of the total project. And the IRS lets you to deduct 100% of them in the first year. So let's say like if you invest $100,000, you might get an deduction of 80,000 that year, depending on your tax bracket.
That's like the government helping cover pretty much your entire upfront investment.
Exactly. The second one is the tangible drilling costs. It's also called TDC in short. This is the physical stuff where equipment like pump jacks, casings, or the oil rigs, you can deduct them all at once, but you depreciate them over a period of 7 years.
Gotcha. Slow benefit, but still a good tax benefit.
Right. And the third one is the depletion allowance, which the IRS gives. Once the oil well starts producing, you're allowed to deduct 15% of the income tax-free every year. Think of it like depreciation of natural resources.
That's really interesting. So between the upfront deductions, the ongoing write-offs, you're really stacking the deck in your favor.
Yes, that's why high-income earners like doctors, lawyers, or entrepreneurs love this space.
Okay, so let's talk pros for a second. Monthly cash flows once wells are producing. Big first-year tax write-offs, 80 to 90%. Diversification across many wells and basins, and inflation resistance, since oil tends to move with inflation.
Yep, that's good stuff, right?
Okay, so there's always cons and risks when you've got pros like that. But what we both know is it's not all sunshine. It's not all cash flow. Pramod, can you share what some of those risks are?
Yeah, sure, Wally. The biggest one is the uncertainty in production of this oil. Even with today's technology, no one can guarantee how much oil a well can produce. Sometimes wells come in strong, sometimes weaker than expected.
Interesting. So how are we supposed to mitigate this risk?
So there are a few good strategies, Wally. The first one is you need to partner with major operators like Exxon, Devon, and Continental. Now, these guys have the best scientists, the geologists, engineers, and the technology, plus the most advanced equipment to predict where oil is. So you do need to partner with them. Also, they use cutting edge drilling techniques to reduce the uncertainty. And apart from that, they also spread the risk by digging about 50 to 100 wells. And that way, if a few wells underperform, the others can balance it out.
Makes perfect sense. It's kind of like diversifying your stock portfolio, but you're doing it with oil wells.
Exactly.
So, Pramod, tell me about, are there any other risks?
Well, there are some more risks, which are oil prices can fall due to global issues or whatnot, due to uncertainty, which is not in anybody's control, right? And the second one is drilling projects can get delayed, probably due to permitting or any other funding or any other issues. The third one is your money is locked up for about 5 to 7 years. So this is not a liquid investment.
So who should even think about investing in an oil and gas fund?
These funds are usually only open to accredited investors. And if you remember, accredited investors are who meet certain income or net worth thresholds. And the minimum investment for these funds starts at $50,000.
Got it. So these are not intended for everyone, but for high earners who want to cut taxes and build passive income. It could be a smart play.
I think it's because of the high volatility and high risk.
That makes sense. So, like we said before, not for everyone, just high earners, and you must be accredited to play in this asset class. Let's go ahead and land this plane. What's all the key takeaways here?
Yeah, sure, Wally. Oil and gas funds give you a chance to actually own a slice of real energy production, capture some of the most generous tax breaks in the IRS code, and potentially earn monthly income for years to come.
But at the same time, price swings, wells can be uncertain, and your money's tied up, so it's not for everyone.
Exactly. And if you're considering it, talk with your tax advisor and make sure it fits your goals and definitely do your due diligence.
Yeah, agreed. Well, let's wrap up today's episode.
If this helped you understand oil and gas investing, please share it with a friend.
And remember, wealth isn't just about making money. It's about keeping it, growing it, and protecting.
See you next time on the IT Investor Podcast.